I'm an investor and I'm getting excited about some of these ideas, but I don't really have a bunch of money in my IRA, but I want to set an account up, and how do I do it? Do I just do an IRA, a Roth? Do I do a solo 401k? Talk about that a little bit.
Yeah, so first thing for viewers to understand is traditional IRA and Roth IRA, two different types of accounts. Most people that have 401ks, thrift savings plans, other employer-sponsored like plans, those are tax-deferred accounts, meaning when they put money in, they got a tax deduction. Eventually, when they take the money out in their retirement, they're going to have to pay taxes. That's what we refer to as tax-deferred growth. So those account types, they would roll over to a traditional IRA to get started. But in addition to the traditional IRA, you have the Roth IRA, which I've talked a lot about. And you're going to tell I'm incredibly passionate about the Roth IRA because of the compounding interest and the absence of taxation benefits. So in contrast to a traditional IRA, a Roth IRA, when I put money in, I don't get a tax deduction, which is fine for me because my goal is to grow this tax-free. And then when I start taking money out after the age of 59 and a half, I pay 0% tax. I just bought a rental property with my Roth account. It's a duplex. It's in Maple Heights, and it's cash flowing at about $1,500 a month. All right, $750 a unit. The net is around $1,300. So I got $1,300 coming back into that Roth tax-free. I'll never pay a dime of tax. If I pass away and I leave it to my wife, it's tax-free to her. And if I leave it to a child, for instance, they're going to be able to enjoy the benefits of that for 10 years tax-free as well. So the Roth IRA from an estate planning perspective, personally for my retirement wealth accumulation perspective, is certainly king to maybe a traditional IRA. But a traditional IRA still has the tax deferred benefits. So that's between traditional and Roth account for everybody to understand.
So real quick, John, I used to explain this to my clients. The perfect investment would have 3 tax advantages. The perfect investment, which doesn't exist, but it would be pre-tax going in, tax deferred growth or tax-free growth, and tax-free on the way out when you take a withdrawal, right? The traditional IRA gets the first 2, right? Pre-tax, so you get a deduction, tax deferred growth, but it's taxed on the way out, okay? A Roth also receives 2, but it's the last 2, right? You don't get the deduction up front, tax-free growth, tax-free withdrawals, right? And what we're saying is we're taking potentially for most real estate investors, a Roth absolutely every day of the week for sure, and probably twice on Sunday. You want to use a Roth because we can grow this sucker so big. We want to be able to tap into that tax-free at 59 and a half. And in some cases, in the cases of inherited Roths, you can actually tap into that money before legal retirement age, which I want to get to maybe in a few minutes. But why don't you continue? How do we get money into these types of accounts?
Yep. So if you have an existing retirement account, you could roll money over into those accounts. And if you only have traditional IRA money and you want to get into a Roth environment, that's okay. We can actually talk through the concept of converting funds from your traditional to your Roth account. The couple I mentioned before with the 14 rental properties, cash flowing residential properties, they started with traditional money from 401ks. They converted it into a Roth to get the taxes out of the way now. And now they have over $1 million in properties in cash. They took their accounts from $100,000 to over $1 million in assets in cash. So they got the taxes out of the way in the seed so they don't have to pay it on the crop. But ultimately, to get money in there, you can roll money in. You can also make contributions. You can contribute up to $6,000 when you're under the age of 50. When you're 50 and over, the government allows you to do what's called a catch-up, and you can contribute up to $7,000. Now, this is really important for folks to understand. It's April 15th today, tax filing deadline, but that's been extended to July 15th. So if you're taking advantage of that extension, your contribution will also be extended, which means you can make a 2019 contribution and a 2020 contribution, so as long as you're eligible. So if I didn't make a 2019 contribution, I can put $6,000 in at my age for 19, $6,000 in for 20. That gets me $12,000. And then my wife, even if she's not working, if I have the earned income and she doesn't, that's okay. I can put 6,000 in for her, 6,000 in for 2020 for her. That gives us, as a married filing joint couple, that gives us $24,000 in Roth money. But here's the other account type that everyone should know about on this call. And Greg and Don, I understand that a lot of the folks on today's call are real estate entrepreneurs. They're self-employed individuals. A solo 401k, solo 401k, also known as an individual 401k, Indy 401k, QRP. Ultimately, it's all the same. If you open a solo 401k as a self-employed individual, providing you have taxable wages or taxable earned income, meaning income that you've paid Medicare and Social Security tax on and ordinary income taxes, then you can qualify for a solo 401k, providing that you don't have any employees. So Greg, unfortunately, you're not going to qualify for this, but for those out there that are real estate agents, you have commissions from real estate sales, you're flipping houses.
But wait a second, what if so there's always ways, like, how can I, right? So if I have two companies that have a lot of employees, there's nothing preventing me from setting up another company to participate in the solo 401k.
I love the creativity. Unfortunately, the government's thought about this. They're going to consider you to be in a controlled group.
Okay.
Having all that being said, Greg, it's okay, because you can actually self-direct a multi-participant 401k as well. And that's something that we've accommodated investors with in the past.
Okay.
But for somebody that's self-employed, that doesn't have any employees, a solo 401k is very easy to open. It's very low cost, very easy to record keep and administrate. And so the key element to all of this for viewers to understand is that with a solo 401k, there's more bells and whistles. And you could potentially contribute higher amounts compared to just a traditional or Roth, which are limited by that 6,000 or 7,000. The contributions go like this. If you are under the age of 50, as an employee, you can contribute up to $19,500. If you're 50 and over, you can contribute up to $26,000. But here's the deal. You're not forced to only put it into a tax deferred bucket and get a deduction. You could actually put it in what's called a Roth component of the solo 401k. So my 19.5 or 26, depending on my age, I can put it into a Roth environment right away. And that's just as an employee. I then put my employer cap on because I'm an employee and an employer of my own self-employed business. As an employer, I can defer up to 20% of my self-employment income, or if I'm payrolling myself, it's 25%, not to exceed $37,500. Now, I don't want viewers to get lost in the details. The bottom line is, let's say you pay yourself $100,000, Greg, as a self-employed individual. You put 19.5 into the Roth bucket of this solo 401k, after-tax money, going to grow tax-free. And then we're going to take 25% of your 100,000, defer it into the 401k, which is 25,000. So now we got 25,000 plus 19.5. And what we're going to do with that employer match or deferral is we're going to convert it over into the Roth. So now we got our 19.5 plus our 25,000, right? We got over 40,000 of Roth dollars created by paying yourself 100,000 and setting up a solo 401k the right way. Now, all of this requires you to have self-employment income, and that's really, really critical. The IRS states that your contributions to a solo 401k need to be recurring and substantial. So if you don't have any self-employment earned income that you're paying payroll taxes on and ordinary income taxes on, then you can't have a solo 401k. But if you do, the benefits of this solo 401k with this Roth component, imagine what you could do with 40,000 in a Roth component, and then also have your Roth IRA over here, because you can have both. You can have solo 401k and Roth IRA all at the same time.